Hi guys, welcome back to Morant's Rants. Plenty of good information, a little bit of motivation, a whole lot of truth, no financial advice. I want to give you an update on the markets and an update on how I feel this economy is going to be going, moving forward for the rest of this year. Right now, Jerome Powell just announced that they're going to pause the rate cuts. And we know that President Trump has been asking for rate cuts for corporate America. Here's the thing, guys. 4%, 5% Fed rate, it's not like life or death. But the truth is, there's some high yield bonds out there for corporate America. So there's this sector of investing called distressed credit investing. And private equity tends to give out these high yield bonds, right? It would be like for you, like a shark loan, like a loan shark comes out and they go, hey man, we're going to give you this, but we want 10%, we want 15%. That's a massive amount of money when we're dealing with billions and millions. And certainly for companies that are distressed, where they don't make a profit. But the other way to get debt, the other way to leverage your debt is to use assets. Assets as collateral when you actually borrow. Because people will say, well, what do you have that warrants me to give you $10 billion? And you know what? I have these chips. I have these NVIDIA chips that I just bought because they're using debt to buy things, right? And what are they buying? They're buying NVIDIA chips because, as you know, just like in the 1920s, now we're here in the 2020s, 100 years later, companies are investing into other companies. And so how they're doing it, they're taking the product and they're using that as collateral. Well, as of this last month, DeepSeek, the Chinese AI company, comes out and says they can do it for less. They can do AI models for less. They can do it with older chips. Therefore, your new chips are obsolete. And this demand that NVIDIA has claimed is now, I don't know, fraudulent, or maybe it's not needed. So a lot of companies have to go out there and reevaluate how they're going to do their CapEx. So their capital expenditures were up in the 50 billion range. I showed you Oracle, I showed you Tesla, Microsoft, a whole bunch of these companies that are actually saying they're going to spend billions of dollars in AI infrastructure. Maybe it won't cost so much. But there's two different ways. We're building data centers, we're getting energy, and then the chips themselves, right? So what if we don't need as much energy? What if we don't need as big data centers? What if we put a pause on all of it because other people have found a way to do it better? I just heard Alibaba this morning announce that they have a better AI than DeepSeek. China's still moving. And, I've always studied Alibaba because I really thought it was deep value at $70 a share when it was at 70 because I knew about the cash on hand. I knew about the business model. They make tons of money. And I was like, this doesn't make sense. But then, of course, I follow Ryan Cohen, the billionaire investor, and he's invested into Alibaba. I said, okay, he's a smart guy. He's always made good investments, so I'm going to follow him, right? So I'm just giving you that news. But here's the other part of viewing it. All these guys, the other part of the accounting, all these guys that are buying things on debt, there's the interest carried over. We got that, carried interest. And then you also have what they call goodwill. I've talked about goodwill in the past where I thought companies would have to write it off because they're not making money. Well, the building's still worth something, right? The assets are still there and they're still worth something. Well, guess what? These chips are not worth something. These assets that you bought no longer will generate the profit that they claim they would. I mean, NVIDIA has to speak on it, but they can't yet, I guess. And I was reading a guy on Twitter and he said, NVIDIA has to announce that they are not going to make a profit. That they're in limbo. Like it's a dire situation because they've already front loaded all these contracts for billions of dollars for chips that they haven't even produced yet, designed yet, but they claim there's order for them, right? A necessity for them. And now there's not going to be. So NVIDIA, your earnings are going to come down, or your outlook or your forward guidance and however you want to say it. But how about all these companies that borrowed money off of these assets that are no longer valuable or depreciating right now? It looks like they're going to be devalued. You're going to be in very big trouble accounting wise. You're going to take billions of dollars of loss on market cap because you actually have to write off the goodwill. And it's certainly because an independent auditor will review your balance sheet every year, and they're going to give you an evaluation. They're going to be like, hey, all those H200s or whatever they're called, right? These nobody even wants them. Nobody even uses them. But you have a shit ton, right? You spent billions of dollars on them. It's gonna be worth nothing. So this is the problem that Microsoft has right now. This is the problem that I'll get with super microcomputers. We'll talk about that in a minute. But so when I look at the whole AI industry, kind of like the .com bubble, everyone has to write off all these expenses, they've been doing. They're going to have to write them down, not write them off, but write them down, because if you are deducting value, now we're going to talk about the interest, right? Now we're going to talk about this. So there's two ways of making money in this market. There's people that are invested money with the companies themselves, and or people that are lending them the money themselves. But a lot of those market makers, not market makers, but a lot of those funds, right? Those, I guess, hedge funds that are giving you these bonds, when they give you the bonds, they have these little sticky notes on them, right? I want my people on the board of directors. I want to know what you're doing with your money. Remember, they're called covenants. And right now, you're in a high covenant environment. They're called Covey-heavy bonds. There's covenant light. There's this covenant light era that we had the last 15 years. That's gone. Right now, people are acting like 5% is make or death, life or death, right? 5% interest rates. Oh my God. But after I spoke to some really, I guess, educated people on the matter and people that have been around for decades, 20, 30 decades. I talked to Mark Faber. And you guys don't know, I interviewed Mark Faber 2 weeks ago on the channel. Mark Faber has been in finance for 60 years. He used to work at Drexel Burnham Lambert. He's on the desk, the international desk there for the high yield bond desk. And he's also an author, and he does the author and editor of the Boom, Doom, and Gloom website, whatever the hell it's called. But that guy tells me, he goes, hey, Marantz, 5% is nothing. 5% is a walk in the park. They've got it. The problem is this. The problem is Japan. The problem is the carry trade. The problem is that when you increase interest rates elsewhere, not here in the States, it's elsewhere. Because the rich people, they actually take their cash and they go put it in other currency to get a better rate. And right now, Japan was the better rate. Japan was at 0 for years. Then Japan all of a sudden went up 0.25. Now they're at 0.7. Like, they literally are creeping up, and you think to yourself, well, it's still only 1%, Marantz. No, we're talking about trillions. We're talking about billions. We're talking about money carried over. And this happened in August of this year when they increased interest rates, and no one was ready for that carry trade. This time they're ready. This time they were ready. You know what they're ready with? DeepSeek. DeepSeek came out a month ago. And all of a sudden, the headline gets sensationalized and pushed out in front of you, and that actually drew out exit liquidity from the AI trade of $1 trillion. So yeah, they're able to flex it. They're able to get through it. But remember, this is all risk. This is risk that's been managed for decades, jumped around from spot to spot to spot. And if you don't think, and this is not a conspiracy theory, if it was a conspiracy theory and we're all wrong, then Credit Suisse would exist, Lehman Brothers would exist, Bear Stearns would exist, right? These financial institutions that were just dead wrong on the risk assessment, right? So that's what we're looking at. So when you go look at how every weekend liquidity is pumped out of crypto and then pumped right back into the markets, and you'll see winners and losers, and it's a zero net sum game. It's people just transferring wealth from one spot to the next. That's why I don't get it. That's why I don't get why people were so up in arms that GameStop was going to ruin the economy or destroy the economy 4 years ago, that they halted trading on GameStop. It was like, that wasn't going to ruin the economy. It wasn't a mo-ass event. Nope. That was just a couple of dudes that were going to lose their ass, and those couple of dudes happened to own and manage markets. That's it. It's not the wealth of the world yet. But I tell you, I hope you're not on the other side of that trade. That's what I'll tell you. All right, other things I want to talk about. I want to give you an update on Connect the Dots. You guys know the Connect the Dots series on my channel is 85 editions now. And 85 episodes of Connect the Dots, and they've gotten better over time. And I'm proud. It's one of the most proud things I've ever done. But on episode 15, I had talked about a company 2 years ago, and I said this company is going to go bankrupt. And they're doing all the steps to make it go bankrupt. Now, these steps are well known. They're chronicled via the Milken Institute and the way they systematically tear apart companies to bankrupt them and enrich themselves. So let me give you this example of why we're so correct on episode 15. The company is called Kohl's. Kohl's is a retail store here in America. And Kohl's, once the darling, has assets. They probably have around 12 to 13 billion worth of assets. They own the buildings, but they have no cash. They have no cash, and that's because 3 hedge funds infiltrated them and forced a takeover, which these hedge funds did the same thing at Bed Bath & Beyond, and they're doing the same thing right now at Kohl's. And they also did the same thing at Big Lots. So they rid the coffers, they extend on debt, and they make money off the bankruptcy. So let's just think about these steps, okay? Kohl's, they hired Thomas Kingsbury as their CEO about 3 years ago, after Michelle Gass refused to give in to private equity. She got pushed out, and here comes Thomas Kingsbury. He's in. What's the first thing he does? He takes a loan of $1.5 billion. That bond itself could never be paid back. The amount of money that Kohl's does not make is astonishing. They only have $200 million cash on hand at a time. They don't carry more than $200 million cash. So what are they doing with their money? Well, they pay out dividends. They pay out dividends to the tune currently of 15%. It's a 15% yield on the stock itself, the dividends. So when you see dividends on Kohl's, just know that the stock price is like $12 and their dividend's like $1. It's a good dividend. It's like 50 cents every quarter, which is a great return for the stock. But here's the problem though. That can't go on forever. They can't keep up with this. It's gone. It's going to be gone. And I'll tell you why it's going to be gone and why you should pay attention. It's going to be gone because their cash is only $200 million. And they're not making a profit the way they have in the past. And they're doing things, they're closing stores. But to sell off their buildings, their properties is the plan. Sell off the properties, lease them back. Now you have a huge cash pot. And when you get this huge cash pot, what do? You drive up your stock price? You pay out dividends? Maybe. Or you pay out bonuses to the executives on the team. And remember what I told you. All these executives are on the take. So, when you think about Kohl's, and I'll say that, I don't care if people think I'm wrong on this. I'm not wrong. I'm telling you. They just got a new CEO because Thomas Kingsbury finally retired. They already set it up. Hey, he signed that deal with Sephora for $1.5 billion, or he took a bond for $1.5 billion, signed the deal with Sephora, then he spent $800 million on CapEx to refurbish the buildings. That's just money spent and wasted. You don't make that kind of money. They don't make that kind of profit, I promise you. They can't ever pay off $1.5 billion unless they sell their properties. So they're going to sell them and they're going to lease them back. But they announced layoffs. They announced store closures. That's all this year. And what did they announce this morning? They announced a 10% cut in their corporate employment. That means they're cutting out executives. Now, they're going to cut out the executives, guys, who are not on the side of private equity. I'm sorry to tell it to you. They're going to cut out the executives so that the fat cats that are there, get a bigger share bite. So now they get to get more shares. They get a higher bonus. There's more cash to split amongst lesser people. So thanks for cutting out your executive team, Kohl's. You're doing the playbook. And one step after another. Every day it's like that for me. I love it. I laugh. So let's run it all back. GameStop's the best investment you could ever make right now. Stock price is awesome. They're flat today on a day where everyone's red and green, falling down. Nvidia, they're going to get hit. Nvidia's going to get hit because they're going to be in big trouble if they don't announce the fact that their numbers are cooked. Their numbers are absolutely cooked. There's no way. Remember, guys, Nvidia does mark-to-market accounting. Mark-to-market accounting, okay? Mark-to-market accounting is where you front-load the number, the contract itself. If I sign a contract for 20 years for $100 million, they claim the whole $100 million the first year as profit. No way. You think these guys sign contracts for chips that they don't need? Obsolete chips that these guys haven't even cut up or cooked? They haven't even delivered? This is the same accounting practice that Enron did for years, and it finally caught up to them. So mark-to-market accounting is there. Their largest supplier of data center, well, I would say of the chassis for the data centers and the buyers of chips and everything else. One of the third largest, actually, is Super Microcomputers. Super Microcomputers has not filed a 10K in over half a year. They have not filed a 10Q as well. And they're going to be non-NASDAQ compliant come February. Oh, wait, that's 2 days away. And yeah, they're in big trouble because all of their money is the same, just like NVIDIA's, where it's circulating, right? It's round tripping. It's where they're paying money into other companies that are in turn paying money back to them. And if you don't know what CoreWeave is, I'd love to have this conversation about, I guess, hedge funds, and I would tell you private equity investing money into CoreWeave to the tune of like $10 billion CoreWeave, all for some chips that are what now? Worth about a bag of Fritos, Doritos, Ruffles. That's what those chips are worth. Certainly that's the demand. So CoreWeave, you explain to me how you're going to survive the $10 billion swing that you just have. How are we going to, but they're a private company, so they're not going to have to expose themselves not just yet. But investigators are going to be coming around snooping at NVIDIA and asking, why did the insiders trade off $2.5 billion worth of shares over the last year? Because they knew. They knew the contracts are front loaded. They knew that the accounting doesn't add up. NVIDIA only gives you guidance one quarter at a time. I wonder, you're so confident? You think you got the best thing going? 2 companies just showed up today and said, no, you don't. One, I think, was orchestrated. I think the DeepSeek thing was orchestrated because to back out the money from the planned carry trade of Japan. That's what I think. The timing it makes too much sense. So anyway, guys, that's the update on the market today, on what I see coming. Can we talk tariffs? We could talk tariffs. You know, back in the 1940s, there was this thing called the Marshall Plan. And the Marshall Plan agreed after World War II. You know, FDR and the boys, they said, you know what, guys, we should allow... It wasn't FDR, I think it was after him. It was the next president because FDR passed away. But the Marshall Plan said we should allow other countries to rebuild. It's like we felt bad for the guys. So what do? We allow Japan, we allow Germany to rebuild, and they get to impose a tariff on us, but we don't get to impose a tariff on them. Tariff-free, tax-free goods and services sold in America. We're willing to buy their items. And we allowed them to do it for so long. But now we're changing up the game. And now you're going to have equal footing. Certainly for automotive and a lot of things that you sell retail. But it makes you wonder why other countries don't pay a special tax, a tariff, for our goods. Well, you know, we do. We have to pay a special tax if we want to sell in their countries. So why shouldn't they have to pay to sell here? Oh, because the cost of goods would go up. That's right. Okay, sorry. So the cost of goods sold would go up if they had to pay a special tariff. Right? Wrong. All they got to do is build it here. That's all they got to do. Stop being scared, guys. Don't be scared of this new world you live in. It's only been 7 days. GameStop. Can't stop, won't stop. GameStop. I'm going to be here forever. Peace.